Welcome to the Performance Enhancing Podcast. It's like steroids for your brain. A podcast for people looking to live life at their peak potential. Chock full of real-world tools and knowledge that you can apply in your life today. By providing you with a lens into the lives, beliefs, practices, and actions of those who are already living extraordinary lives, the Performance Enhancing Podcast will help you shift your mindset or create that change in your daily rituals and habits so you can explode with success in the areas of life that are most important to you. So get ready for another dose of Performance Enhancing Podcast with SatoriPrime. Here's your host, Elon Ferdman.
Hello, everyone. Welcome back to another Pep Talk with your host, Elon Ferdman. I'm very, very excited to share with you today's guest because we've never had anyone talk about this topic before, even though I'm sure these are questions that you ask yourself and your friends quite often. That question is, where do I invest my money? What do I park it in so that I get a nice, consistent return that's somewhat safe? And I think we all know the answer internally, right? Real estate is a huge weapon for people in this industry or any industry in order to protect their money. However, having been in that world previously and watching it crumble to the ground and assets just completely getting diminished in value, I've always had a little bit of a hesitation. And Jason Hartman, who's my guest today and for the next two parts, really shifted that for me, because he looks at it in a very, very different approach. He has something that he calls the 10 Commandments of Investing, which we're going to touch into. But as an overall concept, he's not looking for the sexy gambler mentality of finding markets that are appreciating like crazy. He's kind of looking for those boring, safe cash flow markets, and he's generating revenue from his properties on day one, which is difficult to do. And we're going to talk about the do's and a lot of the don'ts of that world. So I learned a ton. Make sure that you have something to write down and take notes with, because I'm sure you will too. And I hope that you do reach out to Jason and his organization to see how they can potentially help you. I know I definitely will be reaching out to him to help me. So hope you enjoy this. Again, we haven't done anything like this before on a pep talk. And let me know what you think. It was tremendously valuable for myself. So enjoy. All right, everyone. Welcome back to another Pep Talk or Performance Enhancing Podcast. And today I brought on someone who's going to help us with a couple of things. One, for those of you out there trying to figure out what to do with the money that you've earned in the careers that you've chosen. We all know that real estate is king. So we're going to talk a little bit about that and investing in that model. We're also going to talk about those people that want to just use real estate as their business and actually become entrepreneurial in that world. So I brought on an expert who teaches, not only does this for a living, but actually teaches others. His name is Jason Hartman. So welcome to the show.
Hey, thank you very much. And just so your listeners understand, if they're watching on video, this is not a model of the solar system here, okay? This is my microphone housing that reduces echo, and that's what happens when you got 10-foot ceilings and a lot of hard surfaces, and so it makes it sound better. So that's why I have this strange-looking object in front of me.
I don't just circle the sun. It actually
this is called a Kubota eyeball. It took me a while to find it, but
Kubota eyeball.
Kubota, yeah.
Kubota.
It's a Canadian company, makes it $200. And you can reduce the echo in your room with all the hard surfaces. So there you go.
Brilliant. I also saw you had the little for Hartman Media.
Oh yeah, a little mic flag. Yeah, that's just
That's very cool as well.
Yeah, there you go. Yep. So anyway, we are going to talk about real estate, right?
Yes. Tell me. Yeah, not just my get-ups.
Not just microphones. So I think income property is the most historically proven asset class in the entire world. I used to say in America. And my audience on my podcast is 164 countries. I know you have the same thing.
Yep.
You've got a very big audience around the world. And I really have never, ever had even one person challenge me on that statement. And, I think it's true. It's just, everybody has access to it. Well, almost everybody. It's just been proven for so many years that people can create wealth with income-producing real estate. So, as long as you do it right, and we'll talk about that today, I think it's a pretty tried and true methodology.
How did you get started in this whole real estate investment world?
Well, I grew up rather on the poor side of the tracks, if you will, in Los Angeles, California. When I was 16 years old, I happened to see an infomercial for one of those sort of sleazy real estate guru guys. And, I thought it was intriguing, and I was only 16. I was going to high school. I went out and I got his book. I read 3 chapters. I put it down. My mom read the rest, and she got really interested in the topic. And 2 years later, here I'm 18. Now I'm about to graduate from high school. And she says to me, Jason, you got me interested in this real estate thing. There's a big seminar this weekend by Disneyland in Anaheim, California. Why don't you go? I rounded up 9 of my buddies from high school. I got them all to go on Friday night. And it was one of those pitch fest type seminars where every speaker's promoting something. And, by the end of the weekend, I was the only one left. All of my friends went to the beach and, had a good time. But I was really serious about this stuff. And so I got my real estate license. I enrolled in just licensing school right after that. So I could kind of learn the basics. I didn't know what they were talking about. And my first year of college, I was 19. I got my license. I had it in hand. I started selling real estate part-time. And then about 6 months after that, I became an investor by buying my first property at age 20.
Brilliant. That's amazing. And now you've gotten to the point where you're actually teaching people how to do this for themselves. So you're the guy.
Yeah, I was in the traditional real estate business for several years. I bought a real estate company. I sold it to Coldwell Banker in 2005. And it took about a year to negotiate that deal with Coldwell Banker. And as I was doing that, I was kind of thinking, what do I do next? I mean, I'm way too young to retire. That's boring. People die really quick when they retire. Even if you got the money, you got to have something to do. You got to have something to keep you interested in life. And I started looking around for places to invest some of my earnings. And I was always a real estate investor. Over the years, I had purchased many properties. But this time, number one, I had more cash to do it. And number two, I wanted to do it on a diversified basis. I wanted to invest nationwide. And I didn't want to be tied down to any one market. I wanted to diversify geographically. And I started looking around and trying to find someone to help me with this. And then I was kind of trying to do it myself. And it was really difficult. And I thought to myself one day, why can't there be a financial services firm like Wall Street? Wall Street has Merrill Lynch, they have Ameriprise, they have, TD Waterhouse, they have all these companies out there, right, that sell their crappy products. And but they have a very good system of selling, right? And I thought, why can't there be a financial services firm for real estate investors? And there wasn't one. So I just created one. And I was my own first client. And I started setting up this whole unique business model that I'm happy to tell you about. And it all went from there. And so far, I've been investing nationwide for 12 years now. And I've been helping thousands of clients do the same.
It's so crazy how the best products tend to come out of some individual's necessity, and they build it for themselves, and then they're like, "Oh, this is actually pretty good. We should."
Absolutely. Someone has a great recipe, and all their friends tell them, "This is really good. You ought to market this," and then they do, and they become world famous, right?
Yeah,
it's true. That's what's so great about entrepreneurship. It's all out of we notice gaps in the marketplace, and we think, why doesn't someone offer this? There's this huge opportunity. Like, I want to buy this. Everyone would buy this. They say that about gift giving. If you want to know how to pick a gift for someone, look for something you would like to receive, right?
Yeah.
I think the same is true with entrepreneurship.
So now that you're kind of on the other side of it, teaching people as well, you've obviously come up with some sort of system, or I don't want to say formula, I hate that word, but some sort of smart investment system. So could you walk people through at least the basics of it, and then we'll kind of dig deeper as we go into it?
Absolutely. So my core content is something I call the 10 Commandments of Successful Investing. And that's a bit of a mouthful, but I developed that back in 2005. And basically just something to kind of outline, what is a good real estate investor? What is a good conservative, prudent real estate investor? What do they do? What can you model from their behaviors? And so I'll just touch on a few of them. We won't go through all 10. But commandment number 3 is really resonated with a lot of people, and it is thou shalt maintain control. And what that means is that, we shouldn't relinquish our financial future to somebody else. We should be in control of our investments, whether it, be by, investing in an LLC, a stock, a bond, a mutual fund, whatever it is. Anytime we do that kind of thing, we relinquish control to somebody else. And when you relinquish control, you leave yourself susceptible to 3 major problems. The first one is you might be investing with a crook. The second problem is you might be investing with an idiot. And either way, you're going to lose money, either through their sleaziness or their stupidity. And the third problem is, assuming they're honest and competent, they take a huge management fee off the top for managing the deal. And so, we don't have to talk about the scandals on Wall Street. They're everywhere, from Bernie Madoff to Enron to WorldCom, Global Crossing. I mean, the list is just endless, right? Yeah. Every day, practically, you hear about a new scandal on Wall Street. Even the late Steve Jobs, who everybody reveres as this great guy, he was accused, and it's probably true from what I've read, of backdating options and doing all sorts of sleazy stuff with Apple stock. And and he was always the guy who wasn't greedy, right? It wasn't about money. It was about making a dent in the universe. Whatever. And so don't relinquish control. Don't be investing with a crook. Don't invest with an idiot. But that third problem, that assuming they're honest and competent, they take a huge management fee off the top. So let me give you an example of this. Larry Ellison, a famous CEO most people have heard of. He's the founder and CEO of Oracle, the Oracle computer, and or databases, whatever they use, software. From 2000 to 2002, in just 2 years, in 2 short years, Larry Ellison's personal take from Oracle was $781 million. $781 million, almost $1 billion in 2 years. Okay. Wow. And that would be fine. I'm a capitalist. I love to see successful people. I love to see them making money. But the problem is, it is totally out of alignment with the shareholders. Yeah. It's during that same 2-year period that Larry took almost $1 billion out of the company. His shareholders, the people who had faith in him, the people who had faith in his company, the people who invested their hard-earned money, their life savings in many cases, they lost 61% of their investment during that same 2-year period. So, basically Wall Street owns the government. They get all the laws made in their favor. You're not going to win this game. And then you talk about high-frequency traders, and it's absurd. It's a losing game, okay? It's for insiders. So let's assume we all get that, right? That, maintain control, be a direct investor, only put your money into things that you actually control. And I think, single-family homes, apartment complexes, I love those. Those are great. I own a mobile home park too. Those are great, more complicated for sure. But the good old humble single-family home is pretty great. Don't underestimate that one as a wealth creator. It's worked for tens of millions of people. And so that's commandment number 3. Commandment number 5 is thou shalt not gamble. And so what we mean by that is that the property must make sense the day you buy it from a cash flow perspective, or you don't buy it. It's gotta make sense from a cash flow perspective. See, most people think they're real estate investors, but what they really are is gamblers. They're really speculators. They're buying based on what's called the greater fool theory. And that goes that no matter what I pay, some greater fool will buy and pay more. And, it's not about appreciation. It's not about capital appreciation or speculation like that. If that comes, great. I can spend it as well as the next guy, but that's the icing on the cake. The cake itself is cash flow. And cash flow is really very reliable, actually. Knowing what a property will rent for and the ability to actually receive those rents every month, it's pretty reliable. It's not perfect, but it's pretty darn good. And predicting appreciation, good luck. Yeah.
So let me ask you
business. I've never met anybody who can reliably, accurately predict appreciation or depreciation for that matter.
I mean, I feel like the only way that you could reliably say something's going to go up is if you're going to plan on holding it as in a life, like family trust type thing and hold a property for 50 years. And even then it's not guaranteed. But historically, if I bought a house 50 years ago, today that land or house or whatever will be worth more. But that's not what we're
sure. But there in when we're talking about appreciation, that's a very good point you brought up. I'm glad you mentioned that. Because we have to understand there's really 3 types of markets in the U.S., okay, and around the world. It's the same all around the world. All these rules really apply everywhere. The first type is a cyclical market. That's where the gambler invests. That's a market like virtually all of California, South Florida, the expensive northeastern markets, whether they be Washington, D.C., New York, areas of Connecticut, Massachusetts, Boston's a cyclical market. All of these are very cyclical markets where they go up and they go down and they look like a roller coaster if you're looking at it right. And then there's a linear market. These are the boring markets that never make headlines, okay? These are markets that we like. They're markets like Indianapolis, Memphis, Atlanta, most of the cities in Texas. These are markets that are just these stable, great markets. They have very good cash flow, very low risk, and their pattern on a chart looks like this. It has little dips, it has little ups. It's a very tame roller coaster, if you will. But overall, the trend is up. And in those markets, you can rely on cash flow. And so you come into a bad time, like during the Great Recession that we just got out of, maybe we're arguably still in. Obama wouldn't tell you that. He says the recession's over. Then I look in the mirror and look at my hairline. The recession is not over, man. It's still happening. So, those linear markets, they're not the sexy markets. They don't make a lot of headlines, but they're great places to invest. They're like your bread and butter good market to invest in. Now, there's one more type, okay? And that's a hybrid market. It's a blend of linear and cyclical. And a hybrid market would be a market like Phoenix. Atlanta's becoming a bit more of a hybrid market. Chicago could be considered a hybrid market. Okay, where they look like a little less tame of a roller coaster. It's you've got the roller coaster, maybe the adults ride and the really crazy kids. That's the crazy one, right? That's the cyclical market. The really tame one is for the preschoolers. That's the linear market, and the in between is the hybrid market. Okay, that's the one maybe the teenagers ride. I don't know. No example, but you get the idea.
So let me ask you this. In that scenario, like the first thing you said, or the commandment number 3 is thou shalt maintain control.
Right.
I actually came from, in my previous job, I was doing commercial real estate financing. So we would invest nationally.
Right.
And one of the things that I learned quickly is both in property types and location, if you don't know it like the back of your hand or it's your backyard, you're at a massive disadvantage to someone that's local.
Right. Yeah.
Those are the people that tend to buy for higher amounts when there's no reality of it.
That's dumb money, right? Yeah.
Exactly. So I guess my question is, say I'm in New York, okay? So markets that I can touch around here aren't really fantastic.
Yeah.
Just because
they're a lot less than fantastic. I mean, New York is so cyclical. I mean, it's so high flying. I had one. I remember I had one New York broker talking about what people were, quote, investing in New York. And here it is. I know what I'm going to say. They buy a $3 million condo.
Yep.
And they rent it for $11,000 per month.
Yep.
That is insane.
That's insane.
That is such a dangerous investment. It's not even funny. Because, we want you to get 1% per month, 1% of the value per month. So if one of our clients is going to invest $3 million, they better be getting $30,000 per month. Okay. That's the thing, because you could buy 30 $100,000 houses, single family homes, and you could diversify them geographically. So here's the problem, and you alluded to it very well, okay? Most people, the money is in a lot of these cyclical markets. It's because that's where the high incomes are, and it's where people depending on which part of the cycle they're in, got lucky and had an appreciation upswing. Okay, so if they were in Manhattan or Brooklyn, Brooklyn's the high flyer now, right? Or if they're in Southern California, where I'm from, or whatever, right? They had a high income, and they went through like one of these cycles, and suddenly they have all this equity that, by the way, on the next cycle is going to dry up. Okay, but they've got that equity now, and they want to take it out and diversify it. So they pull the equity out of their house. They start buying a bunch of properties, and you want to diversify into at least 3 markets. Take the most historically proven asset class, but diversify geographically, because the old saying in real estate that you know all too well is all real estate is local. Yeah. All real estate is local. In a country as large and diverse as the United States, there's no such thing as a national housing market. There are really 400 local markets in the U.S. It's a big country. If you're going through some tiny little country in Europe like Luxembourg, that has a national housing market. Okay, the U.S. does not have a national housing market. It has 400 local markets divided into 3 categories of linear, cyclical, and hybrid. Okay, and so you want to get your eggs out of these cyclical markets before the next cycle, and diversify into a bunch of conservative linear markets and be in 3 of those. Because even if you lived in the best place in the world to invest, say you lived, for example, in Memphis, boring Memphis, right? Which is like Renterville. Hardly anybody buys a home in Memphis. They all rent, okay? The only people that buy homes in Memphis are investors. It's like, and of course I'm making a but it's like got this huge renter population of people that work for FedEx and make $40,000 a year. It's perfect. It's a perfect rental market, okay? And we have lots and lots of clients, some famous ones too, buying properties there through our network, okay? And with that type of market, you don't want to just be in Memphis. Say you're Fred Smith and you started Federal Express, and he lives in Memphis, right? And you're a zillionaire. So you've got lots of money to invest. You want to be in 2 other markets at least. If you're in a good linear market now, you still got to diversify. So
say he knows Memphis, right? And he's investing in Memphis.
Right.
And I think another one that you mentioned was Indianapolis, for example.
Right. Or Atlanta. Or
Atlanta. So how does one...
Not so much now, but
how does one go from your backyard where you know the market, you kind of understand what's happening in that market,
right?
People moving in, people moving out. I get that there's all this data out there, but it's different when you're boots on the ground, kind of steeped in the culture. So how does one go from a market like Memphis and invest in Indianapolis and still win?
Yeah, well, great question. It's easy to make a mistake, and it's easy. I guess, there's really 2 parts to the equation, right? So I guess it's fairly easy, if you do a little research and you've got a brain, to not totally overpay for a property, okay? Especially a residential investment property. They're much simpler than an apartment complex or an office building or something like that, right? So say, for example, you buy the property right. Okay, and it's a long distance property. It's 1,000 miles from your home, for example. And say you buy the property right, but the hardest part is managing the property.
Yeah,
that's where the rubber meets the road, because our investors are into the buy and hold strategy, and they can make pretty reliably, although nothing's guaranteed, of course. I always have to say that. They can make 20, 30, 40% per year on their portfolio. One of our clients, who just started investing with us a year ago, literally, it's almost exactly a year ago, just sent me maybe 2 weeks ago an Excel spreadsheet of his portfolio that he bought from us. And he only had about 10, 12 properties so far. And they're buying more. He's a CPA, very accomplished CPA, has his own firm. And he's starting to buy all over the country, right? And he was getting over 22% on his portfolio the first year, okay? And because income property is a multi-dimensional asset class.
Yeah.
You earn your profit in so many ways. You have a little bit of appreciation, you have some cash flow, you have some tax benefits, you've got leverage, And then you've got another thing that I talk about all the time, and very few people understand, but I'll be happy to explain it. I call it inflation-induced debt destruction. Inflation-induced debt destruction. I know that's a mouthful.
Yeah.
That's a really unique philosophy that I noticed has created wealth for tens of millions of people over the last 3 or 4 decades. So it's not an esoteric theory. It's reality. It happened to tens of millions of people. So it's not even a small number either, and that's just in the U.S. So happy to go over that, time permitting, but that's what you do. You've got to have a team that's going to help you manage those properties. And because I wanted to do this back in 2004, 2005, and I couldn't find anyone to help me, I created that business. And that's what we do. We help people do that, and we've helped thousands of clients do it now.
So out of curiosity, what's when a client works with you guys, what is the management fee that they would be paying for you guys to, I guess, quote unquote, manage their properties?
So first of all, we do 2 things. We either refer them to property managers, okay, that we exert a lot of leverage over because we give those managers a lot of referral business, okay? And we also actually teach people how to self-manage their properties long distance. And, years ago, if you asked me if this was possible, I would have told you you're crazy. But I'm doing it myself, and I've done it a lot of times, and a bunch of our clients do it too. So you can actually, with technology today, with all of the tools we have, whether it be Google Earth, Google Maps, Street View, WeGoLook.com, which is a great service. I had them on my show recently, and Zillow, and all of these other great tools, and all the rental sites. You really can manage your properties yourself from a distance.
All right, my friends, we'll end part 1 right there. Hopefully you enjoyed this very, very informative pep talk. And if you're ready to reach out to Jason, it's simply jasonhartman.com. You can reach out to him there. He also has a real estate investing podcast of his own. So if that's a thing that you're interested in, definitely check that out. And again, jasonhartman.com. Make sure you come back for part 2, where we delve really into a few very philosophical and interesting questions. And as always, we'll talk about the mindset of investing. So make sure you come back and listen to part 2. Hope you have an amazing day. We'll see you on the next Pep Talk.
Did you run through doors till you hit the floor? Did you read my eyes and my aching thoughts? Did you walk through walls till you had to grow? Oh my God, your smile and my soundless calls. Get up, my heart is